back, everyone. So in this lesson we are looking at candlestick patterns. You may remember that we introduced this topic in our Beginning to Trade course, where we talked about 4 distinct candlestick patterns and what they told us about the market. Well, we are going to build on that and introduce all the key patterns you're going to need. There are quite a few, so we've split them into 2 lessons with an assignment in between. This first lesson looks at single candle formations. The second moves into multi-candle formations. There is quite a bit to remember, so we've created a quick reference sheet you can download from the materials section after both lessons. Okay, can anyone remember why traders use candlestick patterns?
Yes, traders use this type of analysis to identify patterns that help them get a read on the market.
Well remembered, that's right. What we are trying to do here is find repeatable patterns that give some insight into the psychology of the participants in the market. We know the balance of power within a market is reflected in the changes of the prices at which participants transact. Candlestick charts plot price movement over time, which enables us as traders to interpret which set of market participants, the bulls or the bears, might have the upper hand. There are many different types of candlestick patterns, and each can tell us certain things about what might be going on in the market. Essentially, traders use them to help recognize trend reversals. This is when the trend changes direction, and continuations when it carries on.
Good, you've linked it back to trends. I'm waiting for you to slip up. Great. So once we know about the different types of candlestick patterns, will we then be all set to get trading?
Well, you will certainly have a good set of tools to help you. But remember, identifying candlestick patterns is only part of the puzzle. It's important to be aware that the patterns we are going to show you are only one part of the overall trading setup. They are your ABCs. You will need to know them when we combine them with other technical trading techniques. There are several single candlestick patterns that we can use to assess how certain market participants are with respect to a trend. In this next part, we'll introduce some of these patterns.
Looking forward to it. Why is knowing certainty important?
Well, when a market is trending and participants become uncertain, it suggests to us that there is a potential for a consolidation or reversal. When we identify a candle like the ones that we are about to show you, it acts as an alert to us to pay attention to that particular market and see how the price action develops. First up, let's look at spinning tops.
I like the sound of these.
With a spinning top pattern, the period opens and market participants fight over where they think the price is heading. As you can see here, the upper and lower wicks are similar in size. The body is small, which tells us that the open and close prices are similar.
I have a question. I know a green body is when the period closes above the opening price and vice versa for red, but with this pattern, is it significant?
Well, when it comes to spinning tops, because the opening and closing prices are so close, there isn't much difference between a green or red body. Spinning top patterns are fairly similar to the neutral or long-legged dojis that we introduced in the Beginning to Trade course. Like these doji patterns, if we see a spinning top in a trend, bullish or bearish, it indicates that there is uncertainty in the market.
So when we identify one of these patterns, does it mean that it's likely to reverse?
Not necessarily. It just means that the market is uncertain. However, when I see one of these patterns starting to form, I do pay more attention to the price action in the next period. I pay more attention to spinning tops if they form close or at some important levels of support and resistance, especially if they were preceded by a number of large candles with big trading ranges. This would indicate to me that the market participants which are influencing the price move are becoming cautious or possibly cashing in their positions.
Okay, so what exactly is a MARUBOZUS? That's a strange term. Have I pronounced it correctly?
I am not sure that I am the most qualified person to be asking about pronunciations, but you are right, it does sound a little strange. A MARUBOZUS pattern can be identified by their large bodies relative to the candles around it and their lack of a wick. These candles occur when one set of participants is in complete control of the trend.
I'm a little confused. How do we work out what large is?
Okay, sorry. When we say large or small, I'm meaning relative to the candles around it. I'm going to show you an example in a minute, and I'll be sure to point this out.
Thanks. And what do MARUBOZUS tell us about the market participants?
Well, unlike spinning tops, these indicate certainty and complete dominance by either bulls or bears, but only if they appear in a trend. When there is an uptrend, a bullish, in our case green MARUBOZUS, would indicate certainty in the uptrend. The same is true for a bearish or red MARUBOZUS in a downtrend.
And what if we see a bearish MARUBOZUS in an uptrend or a bullish one in a downtrend?
Well, those types of patterns, especially if they form at areas of support or resistance, might be the start of a multi-period reversal pattern. We are moving on to these next, but what it doesn't mean is certainty for that trend. Explain how spinning tops and MARUBOZUS provide us with insights into market psychology. Let's take a look at some examples in a real market. This is a weekly chart of the Dow Jones, also known as Wall Street. We can see it's been trending up for about a year. So the first condition of a MARUBOZUS and spinning tops has been met. There are several to choose from, but this is a bullish MARUBOZUS, as is this one, and also there is another one here. The bulls have completely dominated the week's trading and pushed the trend in each case to new highs. You can see how the candle is large compared to the ones around it.
Yes, it's pretty obvious when we see it visually on a chart.
Your turn now. Can you see if you can spot a bearish MARUBOZUS?
Yes, I think that is one there. It's in a slight downtrend, it's big relative to the candles around it, and there aren't any wicks.
Good stuff. Yes, I would say that's a bearish MARUBOZUS. Well done. If we turn our attention to spinning tops, these two need to be in a trend. There are lots there as well. Can you spot them?
That's one. There's another, and that's also one.
I can't argue with that. Well done. There is uncertainty in the market at these points, but in all cases, the trend has kicked on afterward.
So, these terms ring a bell. We've covered hammers and shooting star patterns before, haven't we?
We have. We introduced it in our previous course, but we are going to expand on it here. Can you remember what one is?
Well, if I remember correctly, it's a reversal pattern. A hammer has a long lower shadow, a small body at the top, and little or no upper shadow.
Spot on, well remembered. The lower wick should be at least 2 times the body and upper wick, if there is one. It's a bullish trend reversal pattern, so it must form in a downtrend to be valid.
And does the colour of the body matter?
The color does matter, but only a little bit. A green top would be slightly more bullish, but it's only minor. Now, if we take the hammer formation and mirror it, it becomes a shooting star formation.
Ah, yes, so shooting stars occur in uptrends and can signal a reversal into a bearish downtrend. Is that right?
Correct. As with hammers, the color of a shooting star body isn't that important, although a red one could be slightly more bearish.
Ah, it's all coming flooding back. I think I'd be fine identifying these on a chart, but what do they actually tell us about the psychology of the market?
Let's take a look at what is happening with hammers. The market is in an established downtrend. This means the bears are in control, pushing the price lower and lower over time. The price opens and carries on its downward path, but at some point during the period, the balance of power appears to change. The bulls say no and push back the price, so it closes above where the period started. We've possibly experienced a change in sentiment from bears to bulls. If strong enough, it might signal the reversal of the trend. As technical traders, when the next period starts following a hammer, we are looking for confirmation the trend has changed. This typically comes in the form of a bullish candle.
And can we assume, because they're mirror images, the inverse is true for a shooting star, where the pressure exerted by the bulls has been rejected by the bears?
Yes, precisely. Next, I want to introduce some new doji patterns.
So, why have you decided to tell us about dojis now? Don't they indicate uncertainty?
No, not these ones. You will sometimes hear technical traders talk about dragonfly and gravestone dojis. Put the names to one side. Do they look familiar?
No, not really.
Okay, if the dragonfly doji developed in a downtrend and the closing price was a tick higher, it would be a hammer formation?
Oh, yes, I see what you mean. And a gravestone doji is similar to a shooting star?
Yes. Don't confuse these patterns with neutral or long-legged dojis, which indicate uncertainty. Dragonfly and gravestone dojis can also be used when identifying hammers and shooting star formations on a chart, which we are going to move on to now. Let's find a hammer first. This is an hourly chart of gold. We can see a classic hammer develops in a downtrend. The bulls have pushed back and the trend reversed.
That's pretty clear.
Finally, let's show you a shooting star. This is a daily chart of the euro-sterling pair. We can see here at the top of a bullish trend a shooting star has developed. The upper wick is much longer than the red body. The only thing not making this a perfect pattern is a slightly longer lower wick, but overall I'd say this was a good shooting star pattern, and we would have been looking for confirmations when the next period started. The final two single candlestick formations we are going to look at are called inverted hammers and hanging man patterns. Again, these are reversal patterns found in bullish and bearish trends, but with different underlying price action and therefore different changes in participant psychology going on.
Are inverted hammers similar to hammers?
Well, they are similar insofar that inverted hammers are a bullish reversal pattern. That means they form in downtrends and might indicate a change of direction. They also both have small bodies with one long wick. The big difference is the body forms at the bottom instead of the top, and an inverted hammer has a long upper wick. This means the period has opened reversed against the trend, gone higher, but been pushed back to the near the open.
Does the colour of the body matter much here?
Again, only marginally. A green body creates a slightly more bullish indication of reversal. And what do you remember about hanging man patterns?
Well, they're the opposite of an inverted hammer, aren't they?
Yes, that's pretty much correct. If we get our mirror out again and put it to the inverted hammer, we get a hanging man. This pattern is the same shape as a hammer, but it forms in a bullish, uptrending market and is an indication of a bearish reversal.
Okay, and I presume the colour is marginal, with the red body being slightly more bearish.
Yes, correct. Again, the color of the body is not that important. Okay, let's look closer at what these patterns tell us about the market. An inverted hammer occurs when the trend is downward, during which time the bulls have countered but been pushed back by the bears, leaving the close near the open.
Okay, and what might we conclude from this?
All this suggests the bearish general trend is vulnerable. It was challenged by the bulls, but the strength of the bears was strong enough to push back. That raises a flag to traders that the sentiment in the trend might be waning. Typically, it's the next period in the pattern that reveals the insight we are looking for. Here, we can start to look for confirmation of the power of the bulls.
And how would we do that? What would we be looking for?
Well, a few things. If it gaps up, if the next period opens and closes above the body of the inverted hammer, or if it's a solid bullish candle, all suggests the trend might be reversing.
Got it. And what about a hanging man pattern?
With a hanging man pattern, the inverse is true again. The bears have countered against the prevailing trend and the bulls have pushed back. Let's look for these on a chart. We can see an inverted hammer form here.
Yes, it's in a downtrend. Long upper wick, small body.
Quite right, but this reversal fizzled out. The point I want to make here is, although we can retrospectively find examples of reversals coming after a candlestick pattern, it doesn't happen every time. What it does is increase the probability of a reversal just a little, and we need other techniques to confirm. In this instance, I can't see any horizontal support or resistance which might have helped us confirm the reversal. We can actually see another inverted hammer a few days later that eventually led to a sustained reversal.
And the hanging man pattern?
I can't see any on this chart. If I bring up a daily chart of the same pair, I can see a classic hanging man here at the top of this uptrend. This follows a long-legged doji. The market gapped up at the open, was pushed a long way down by the bears, and the bulls resisted, running out of steam, which resulted in the reversal.
Traders identify repeatable candlestick patterns to help them spot potential trend reversals or continuations. Bulls and bears are constantly challenging each other, and candlestick patterns provide a visualization of the psychology of the overall market.
With spinning top patterns, the period opens and market participants fight over where they think the price is heading. They're fairly similar to neutral and long-legged dojis. When we see these in a trend, they indicate uncertainty.
A MARUBOZUS candlestick pattern can be identified by its large body and no wick. These candles occur when one set of participants is in control of a trend. When there's an uptrend, a bullish MARUBOZUS would indicate certainty in the direction of the trend and vice versa.
A hammer has a long lower wick and forms in a downtrend. It's a bullish reversal pattern, which means that the trend may change and head up. If we take the hammer formation and mirror it, it becomes a shooting star formation, which occurs in uptrends and can signal a reverse into a bearish downtrend.
A dragonfly doji has a long lower wick, the same open and closing price, and little or no upper wick. This pattern is similar to a hammer. The inverse is true with gravestone dojis. They have long upper wicks and very small or no lower wick. They also open and close at the same price. These patterns are similar to shooting star formations when seen in an uptrend.
Inverted hammers are similar in shape to shooting stars and gravestone dojis, but they occur in downtrends. The body typically forms at the bottom of the trading range and is a reversal pattern. If we mirror the inverted hammer pattern, we get a hanging man. This reversal pattern is a similar shape to the hammer and dragonfly doji, but it forms in a bullish uptrading market and indicates a bearish reversal.
Well done, everyone. This concludes the first lesson on candlestick patterns. In the next lesson, we'll look at multi-candle patterns. Our courses have been built to enable students to apply what they are learning as we go. To reinforce what you've learned from this lesson, we have prepared an assignment for you to complete and receive feedback on, which you can access next through your dashboard. Hello everyone, and thanks for joining. In our last lesson, we covered single candlestick patterns. Now we are going to look at multi-candle patterns. A multi-candlestick pattern occurs when two or more candles form a recognizable pattern that tells us something about the market. The patterns we are going to introduce are all trend reversal patterns, and each come in bullish and bearish variations.
So, just to confirm, traders use multi-candle patterns to anticipate trend reversals as well?
Yes, but remember, don't view them in isolation. They need to be used in conjunction with other tools. First up, I'd like to introduce a bullish engulfing pattern.
Okay, how would we identify a bullish engulfing pattern then?
Well, these patterns form across two candles and it looks like this. It forms in downtrends and it is a bullish reversal pattern, which means the downward trend might change direction and become bullish. The first candle is a small, bearish or red candle, the body of which is engulfed entirely by the body of the second, bullish green candle.
Interesting to see one candle engulfing another. In what situations is this pattern likely to occur?
Well, for this type of pattern to form, four things need to happen. There is an established downtrend. The first period candle is bearish or at least a neutral doji. Then period 2 is a large green bullish candle engulfing the smaller period 1 candle. Period 2 closes above period 1's high.
And what exactly is going on with the balance between bulls and bears that makes it a reversal pattern?
Traders watch for these formations because they indicate the balance of power in the market has shifted from bears to bulls.
Why? What's happening?
Well, the first candle is a spinning top, isn't it?
Oh yes, it is, and it's in a trend. Does this mean there was uncertainty in the market at that point?
Precisely. Then in the next period, the balance in the market changes quite dramatically within a relatively short period of time. Bulls are really in control and push the price back up above the high of the previous period.
So, I can probably take a stab at guessing what a bearish engulfing pattern is. I'd imagine it's pretty much the opposite of a bullish engulfing pattern.
Yes, a bearish engulfing is the inverse of the bullish pattern. The bearish engulfing candlestick pattern is considered to be a bearish reversal pattern occurring at the top of an uptrend. In an uptrend, a bullish spinning top or neutral doji forms. This is followed in the next period by a big fall in price, engulfing all the action in the first candle. Wick as well.
And is the opposite true of who is broadly in control of the market? Has the balance of power swung from bulls to bears?
Yes, the bulls that have driven the upward trend are becoming indecisive in the first period. There is then an incredible change of sentiment from the open of period 2 to the large bearish real body candle that closed at the lows of the second period. Let's show you these on a chart. Here is a daily chart of DAX. If we zoom in a bit, we can see there is a bearish engulfing pattern here. The market is in an uptrend. The second period gaps up, albeit slightly, and the second period engulfs the first. This one was a successful reversal pattern, but remember, they don't always play out.
Okay, tell us about tweezer patterns.
The tweezer top forms at the top of uptrends and can indicate a bearish reversal.
And how would we identify a tweezer visually?
Well, tweezer tops are one of the few patterns where the shape of the body isn't the most important thing. What we are looking for here are the same or very similar highs. Only then do we check if the first body is in the direction of the trend for a tweezer top that's bullish or green, and the second body is bearish or red.
Right, okay. And what about the lows?
They don't matter too much in tweezers. However, if you get candles the same shape, so long as they meet the initial conditions, it's a slightly better pattern.
Okay, so as a bare minimum, this is what's needed for a tweezer pattern to form. Doesn't that mean we might get lots of combinations?
Yes, you're right. There are several ways tweezer tops can develop, and they can actually develop as other patterns, like the bearish engulfing we saw earlier. Look, so long as the highs are the same, the first candle bullish and the second bearish, it's a tweezer top.
Okay, so what's going on in the market for tweezer tops to form?
It depends which bearish tweezer top pattern occurred, but assuming it was the first pattern we discussed, in the first period, bulls take prices higher, often closing the period near the highs, which is typically a strong bullish sign. However, in the second period, the same high price is reached, but sentiment reverses and brings down the price.
So I take it a tweezer bottom is the opposite of a tweezer top?
Yes, pretty much. The same rules apply, but it's inverse again. A bullish tweezer bottom occurs during a downtrend. Both candles need the same low price. The first candle is bearish and the second bullish. Like with tweezer tops, there can be several combinations of pattern that meet those rules. Shall we try to find some on a chart? So let's have a look at a tweezer pattern in a chart. We are in DAX, 1 hourly. There is a good tweezer top pattern here. The high points are similar. The first candle continues this fairly steep trend. The second candle reverses against the trend. Remember, where the second candle closes is not that important in this formation.
What about here? This looks like a tweezer top as well.
It's very close to one. The highs are a bit further apart than the one I just showed you, but yes, it's in an uptrend. The colors of the body are right and it's a good spot. Well done.
So what are bullish harami patterns?
The harami, meaning pregnant in Japanese, is a candlestick pattern that's considered to be a bullish reversal pattern when formed in a downtrend.
Okay, but why are these patterns referred to as pregnant? Sounds a little strange.
I know it does sound strange, but when you look at the outline of the candle, it looks a little bit like someone that's pregnant, hence the name.
Yeah, I guess it does.
A bullish harami pattern consists of two candles, a larger bearish candle in period 1, a smaller bullish candle in period 2 inside the body of period 1. For this to happen, the price gapped up in period 2 and formed a small bullish candle within the range.
So what is going on with the participants to make this an indication of a bullish reversal?
The second candle in a bullish harami is usually a spinning top or at least a neutral doji. Both mean uncertainty. If this uncertainty is preceded by a large move in the direction of the trend, it is interpreted that this large surge of confidence from the bears ran out of steam and created the uncertainty. A bearish harami occurs in uptrends when there is a large bullish green candle in period 1, followed by a small bearish candle in period 2. The most important aspect of the bearish harami is that prices gapped down on period 2 and formed a small bearish candle inside the first period's range.
And so this would indicate that we've seen significant certainty from the bulls in the first candle, swinging to uncertainty in candle 2.
Spot on. It indicates that bullish traders are potentially taking profits at some resistance area. Here is an example of a bearish harami in an S&P 500 daily chart. We can see it formed in an uptrend. The first candle was in the direction of the trend, and the second bearish candle was within the body of the first.
Okay, what's a dark cloud cover pattern? It sounds a bit gloomy.
Well, this is a bearish reversal pattern. The first candle continues the uptrend with a long bullish body. The next candle gaps up, opening at a new high and then closes down below the midpoint of the body of the first candle.
Got it.
We'd give that pattern the more weight in our analysis if both candles were MARUBOZUS. Also, the further the second candle falls below the halfway point, the stronger the pattern.
So if we were to identify a dark cloud cover pattern, what would it tell us about the market?
Well, the rejection of the gap up is a bearish sign in and of itself, but the retracement into the gains of the previous period indicates more bearish sentiment.
So it would provide us with a strong signal that the price is about to drop?
Remember, candlestick patterns are only indications. They aren't trade signals by themselves. We'll be combining them with other technical analysis techniques later to get the full picture. The bulls are unable to hold the prices higher, and demand is unable to keep up with the building supply. So there is potential for the price to fall.
So from what I can see from the graphic, I'm assuming that piercing patterns are very similar to dark cloud cover patterns, but with the bearish patterns taking hold first?
That is a good observation. These are the inverse of dark cloud cover patterns. They form in downtrends and are bullish reversal patterns. A piercing pattern occurs when we see a big bearish candle in the direction of the trend, followed by a gap down in period 2. But the selling pressure reverses and forms a bullish candle closing above the middle of period 1's bearish candle. Let's find one on a chart. This is a daily chart of the France 40 index, known as the CAC 40. The market is trending down slightly. We can see the second candle gaps down and makes a new low, but retraces at least halfway up the first bearish candle.
And a dark cloud cover pattern?
Here is a classic dark cloud cover pattern in daily DAX.
Where?
Let's zoom in and highlight it.
Yes, it's in an uptrend. The first candle is in the direction of the trend, the second opens higher but then finishes below 50% of the first period.
So this is our final pattern. It's also the only 3-candle pattern we'll show you. There are others, but they are rare.
Sounds good. I'm intrigued.
Like all reversal patterns, it needs to appear in a trend. The morning star is a bullish reversal pattern, so it forms in downtrending markets. The first period of a morning star reversal pattern is a large bearish red candle. In the first period, bears are definitely in charge, usually making new lows.
And then the bulls take over on period 2.
That's almost the case. The second period begins with a bearish gap down. It's clear from the opening of period 2 that the bears are in control. However, the bears don't push the prices much lower. The candlestick on period 2 is quite small and can be bullish, bearish or neutral, like a doji or a spinning top. This is the star part of the formation.
That means uncertainty, doesn't it?
Yes, and it's period 3 that holds the most significance. Period 3 begins with a bullish gap up, and the bulls are able to press prices even further upward, often eliminating the losses seen in period 1.
Ah, right. This makes sense. So it takes longer for the bulls to gain control in a morning star pattern.
In simple terms, yes, that's true. Bears are dominating the trend, but the move is exhausting their impetus. Then the gap down is normally the last push by the bears, and the candle eventually points to indecision by forming a doji or spinning top. The change in sentiment is confirmed by the regenerated bulls, which completes and confirms the pattern.
So I'm guessing that evening stars begin with bullish dominance on the first period, and by period 3 the bears are in control?
Yes, an evening star is a bearish reversal pattern forming in uptrends. The bulls are in control in period 1. This is represented by a large green candle. Candle 2 gaps up, but the bullish sentiment turns to indecisiveness when a spinning top or doji forms. The bears then take over. The price gaps down in period 3 and we see a significant move down, normally wiping out the gains made in period 1.
Can we see one on a chart?
These patterns are quite rare.
Why is that then?
Well, they form over 3 candles, so we need all 3 candles to meet the conditions. The other point is around gapping. This can be fairly common in individual equity markets when trading stops at 4:30 and doesn't open again until 8:30 the next morning. This means the patterns are more likely to form in these markets. In contrast, a currency pair might only be closed for 5 minutes from 10 p.m. to 10:05. The chances of getting 2 gaps in 2 days are a lot slimmer. When analyzing a currency market, you can be slightly forgiving of the gaps. Anyway, here is an evening star pattern in the Nasdaq weekly chart. We have a clear uptrend. The first candle forms in the direction of the trend. Week 2 gaps up slightly and looks like an indecisive spinning top. This is followed by a big gap down and a bearish candle in week 3. As you can see, this preceded a reversal. Right, well done. We've now introduced all the patterns. Before we sum up and finish the module, I want to discuss time frame. What is the period of a candle?
It depends on the time frame you've set in your charts. If you're on a daily setting, then each period is a day and so on.
Good. Yes, it is. When you know the time frame you are trading, daily, 4-hourly, hourly, 15 minutes and so on, it's important to analyze candle patterns only in the time frame you are trading. It's really important to let the candle finish forming in your trading time frame before using it in your analysis.
How do we know the best time frame to trade?
Well, that's one of the last things to work out. You need to learn how to analyze properly first. We're going to be covering that in our next course.
Oh, I see. By not analysing shorter time frames, won't we miss something? If we look for patterns in shorter time frames, won't we get more of an edge?
No, because you are not trading that time frame. Candlestick patterns forming in shorter time frames, when blended, create different patterns in longer time periods.
What do you mean?
Okay, let me show you. A bullish engulfing pattern across 2 periods, say in a 30-minute time frame, when combined make a hammer in an hourly time frame. A bearish engulfing makes a shooting star. A piercing pattern blends to make a hammer. A bearish piercing makes an inverted hammer.
Ah, that's clever.
If shorter period patterns don't go on and form a recognizable pattern in your time frame, then it's not a valid bit of analysis.
A multi-candle pattern occurs when 2 or more candles form a recognisable pattern that tells us something about the market. We've covered lots of patterns. All are indications of a bullish or bearish reversal.
All patterns need to form in a trend. There needs to be a trend to reverse. We looked at bullish and bearish engulfing patterns, where a candle with a small body in the direction of the trend is engulfed by the second candle in the direction against the trend.
Tweezer tops need the same high points, and again they need to be alternative colours, showing a change of trend. Tweezer bottoms are the inverse.
Harami patterns are where there is a large candle body in the direction of the trend, followed by a small candle of indecision.
Dark cloud cover and piercing patterns are also the inverse of each other. They require the first candle to be in the direction of the trend, the price gaps down the following period, then the trend reverses and price closes back near where it started.
The final patterns we looked at were morning and evening stars. These are a 3-candle formation with a large move in the direction of the trend in period 1, a gap in period 2 with little or no move. Finally, period 3 gaps back against the trend and the period wipes out the move made in period 1.
We assess the importance of only analysing candle patterns in your chosen time frame. Patterns in shorter periods can blend in longer periods and make their own distinct patterns.
Thanks everyone for your efforts. We've covered a lot of ground. These patterns probably won't sink in straight away, but if you revisit them and search for them in a live market, they'll soon become second nature. Make sure you can download our quick reference guide on candlestick patterns from the materials sections. You are probably excited to have some real techniques from which we can start to understand a market. Remember, candlestick patterns should not be traded in isolation. They need to be combined as a part of a much wider analysis. This includes support and resistance levels, indicators and price patterns.